Good morning and welcome back to the Opportunistic Trader for December 20th, a Thursday before the triple expiration, which is always exciting. That is the expiration of December S&P and NASDAQ futures contracts that expire on the opening. Usually there's some fireworks. It would have been a very interesting morning if we actually started the morning at 4 o'clock in the morning, where the S&P futures actually traded down to 2476. Imagine if we were there rather than 2506. It would be Armageddon. It would be a blowout where people were getting smashed. But somehow the markets rallied back. The DAX has come off the low about 1%, but still is down 1.8%, trading down 140 points, down almost 18% for the year. The Nikkei is down a smooth 8, 9. The Hang Seng is down 15, 16, and China is down 24. So again, we're the best house on the bad block, and the bad block keeps getting a lot worse. So anyway, I'm joined by Mike and Vince, as always.
Just to update a little bit on breaking news, we just had jobless claims come out roughly very close to in line, 214,000 versus 215,000. But the Philly Fed business outlook came in at 9.4 versus 15, so a weaker number there. Following up, we're going to be data dependent following on what Powell said yesterday. A few of his keys from yesterday were, it seemed like the market was expecting about half of a hike for next year. And by him saying, hey, we're going from 3 to 2, technically is downgrading. That said, the market was not expecting was really hoping he wouldn't say 2. So that was one interesting key from yesterday.
I don't think him saying 2, or even if he said 4 or 6 or 1, it would matter. It would all matter what the data is for next year, as well as stock market prices. But what's interesting this morning is Tepper, I guess, wrote into CNBC, where they were going back and forth. And what he says, which I think is really kind of true, and it was really ringing more clearly to me yesterday in the statement than anything else, is that the Fed, what they call the Fed put, is out of the market, meaning the buying of liquidity and the pushing up of markets. The Fed is quickly unwinding their balance sheet as fast as possible. They're rolling off things, they're selling things, and they're not even close to unwinding. So for them to start buying stuff again would be ridiculous, because they haven't even unwound what they have. So that put of them coming in and saving the market, or propping the market, or doing what they do or what they did to save the market, is a long way away from being reality. And as well, the S&P dropping 10% is literally irrelevant to the Fed. The Fed is here to protect against a crash, a 40, 50, 60, 70% drop. They're not here to worry about market gyrations of 10 or 15%. It's irrelevant to them. The same on the up. Nobody said when the market was doubling pretty much every 2-3 years that they needed to raise rates. They stayed on zero. So the Fed is independent looking. The market, to me, looks extremely skittish. It would not shock me to go out the year on the dead low of the year. For now, we're holding that low of yesterday. I think it traded down to 85. It traded 76 this morning. I wish I was awake to watch it. There must not have been a lot of liquidity. But overall, the markets around the world do not look good. The DAX is down about 1.5% today. We're flat to the tick. And Japan is trading back around 20,000. So it got up to 2 months ago, almost 25,000. So that thing is down almost 20% off the high. Markets are looking skittish. The interesting trade, and Mike probably knows more about this than me, is the trade in the dollar. So the dollar has looked like it's peaked. The euro's back to almost 115, 114 and a half, and
Well, that's an interesting thing you bring up there, and Vince will touch on it as well. But that's an interesting dynamic because supposedly equity markets are freaking out because the Fed was not as dovish as expected. That said, if you look at FX and you look at gold, the dollar is weaker, which they're actually looking at the market expectations. They're basically saying that there's less than a hike priced in now to the market, and they're basically saying the market's saying we don't believe the FX and let's call it gold market is saying we don't believe that the Fed's really going to hike next year, and the dollar's weaker on that. Whereas supposedly the equity market's freaking out because Powell's less dovish. That said, that kind of feeds into what you're saying. It doesn't necessarily make a difference what Powell said yesterday. It's more of the market's going kind of wherever it was kind of position to go before. And then with that, before I pass it over to Vince, who's been very quiet, want to make sure that he finished the
last segment
fix very abruptly,
and he hasn't spoken. This is very unlike him.
He is there. But the last thing before I pass it over to Vince, I gotta say we had a webinar 2 weeks ago. And we have a lot of great webinars, a lot of great content, a lot of great information. But Tracy Schuchart came on technical analysis 2 Mondays ago. So I want to call it about 10 days ago. We were trading 2630 in the S&P, and she pointed out a chart saying that she thought the S&P before Christmas was going to trade 2460. We traded overnight 2475. That's not a bad call there from over 150 S&P points. I was skeptical of before, especially the before Christmas call, giving a time frame, putting a time frame to it, putting a price target to it. And, she really saw this move. And so, very, very good call on that one. And we have the video. It is in the replay tab, but we'll also post it again. But that was a great call on that. So good job, Tracy. But Vince, what are your thoughts here?
My thoughts are everyone should be mad because she wasn't right to the tick.
Well, that's the price. There will be some people. I had my take profit there. Still hasn't been hit.
Exactly. To some points Larry's been making, and you've been echoing that there's other forces that are bigger than the Fed at work here. Like the end of the year unwinds and what have you. If you look at the markets in a time frame, so to speak, consistent with what you're talking about, the stock market was going to sell off anyway, right? These are general statements I'm making that you work with and you wrap your head around. The stock market was my conclusion from just looking at Larry's analysis before the Fed was the stock market is biased lower anyway, okay, because of things outside of the Fed. And then my information was, well, if the market is discounting a dovish hike, then getting a dovish hike is going to be bearish, tying that to what Larry said, because the market's already discounted that. And God forbid he comes in lower than that, which is what he did. So the market was destined to be disappointed in like 3 out of 4 scenarios. And so statistically, it was right to just be outright bearish or sell the relief rally, which we did have in the morning, that Larry also said. Now, tying that to what's going on right now, like, for example, why is gold higher? Why is the dollar down? Why are stocks up but not up so much? It may be a big move from the lows of last night, as Larry pointed out, but why are they, looking at it from an American time frame point of view? Well, here you have it. This is the bigger stuff that's going on, that's happening at the end of the year. People still are unwinding stock positions. Okay, people are not putting new money into stocks. If you want to get an idea of how the first quarter of 2019 is going to go, usually you can get a good idea, and this is from past experience, and today was a stark reminder of that, is that after the last Fed meeting is usually when the banks start either leaking, overtly stating, or buying ahead of their own allocation recommendations for institutional investors for next year. So one of those would be, based on today's activity alone, how come gold's up so much and stocks aren't? And I acknowledge that I was like, gold's going to go down the day after during the gold fix. So,
but yes, you're saying there's a relation to long equities and long gold? That's what you're saying?
As the Fed goes. But what I'm about to say now is different than that. Well, yeah, as the Fed goes, sure. Equities and gold were tied to the dollar, and the Fed raised interest rates. But during the gold fix, yesterday I said if you're bullish gold, buy stocks. If you're bearish, for yesterday for the number, if you're bearish gold, sell stocks. But I tagged it by saying I don't want to go down the rabbit hole here, but I tagged it by saying cynically, sell gold the next day too. But and that was wrong. But what I'm trying to say now is tying to the whole. There are bigger forces at play here. There are bigger forces at play here, and they're still at play. Not only were we destined to go lower because of things bigger than the Fed thing, which is another reason that the VIX was down in a down market, because as people were puking stocks, they were puking hedges because they were closing their books for the year. I mean, this is a hindsight statement, but that's how it is. But today, now you see gold higher, and I'm very, I have high confidence that a big part of this is it's all over, meaning there's no more surprises from the Fed that can happen. And we have our allocations in hand for recommendations for next year's investments, and gold's on that list. And so people are buying ahead of and during allocations. And that should be happening with stocks too, but it ain't. Or it ain't happening that much.
But let me ask you this. How could they recommend Apple at 160 when it's down from, they recommended it at 250?
But that's what I'm saying.
Okay, the guy telling you to buy NVIDIA at 290, okay, when it's trading 138, the stock's in a third. How is he going to be able to tell you? How can you even listen to that? I mean, it's stocks have been
for the analyst's ability, nor am I vouching for the person who listens to the analyst. But I am saying this: if this is a fact in gold, and I'm sure it happens in stocks too, but it's just a fact that in gold, if they're going to come out with a commodity recommendation or an allocation, we recommend to our CTAs or our clients or our institutional investors to put 5% in gold, up from 3% last year. Well, that allocation is either out and in hand, and people are waiting for a dip to buy, or B, that allocation recommendation is not out and banks are buying so that they have inventory to give their clients when they want it. C, it's just plain old front running. I'm just saying that.
Listen,
gold
I'm not
I'm
not disagreeing.
After the last Fed meeting in December is very indicative of these bigger things you're talking about. People are still puking in stocks, and even if an analyst said Apple's going to the moon next year, buy it, they're still selling, hanging over the market, keeping it down. Meanwhile, a yellow inert brick like gold is up $14 because somebody's going to put an allocation to buy 10% of it next year. I'm just saying that there's bigger
I
forces
get
at
what
play
you're
there.
saying. I'm just saying in equities, it's very impossible to tell someone to buy Facebook when the stock was 220 this year and they were recommending it at 220. How can they recommend it at 128? It's literally in half.
That answer comes from Sunil. Hold on. This is from Sunil, Larry. I'm sorry to interrupt, but subscribers come first, and especially when they're funny. The answer, according to Sunil, is, and I know he's saying this tongue in cheek, they will tell you it is a buy as opposed to a strong buy. That's kind of funny.
Yeah, listen, it could be the fact, but overall, I mean, Facebook is. Listen, the low of the year in Facebook's 126. The high of the year is like 218 or 219. It's in half. The Apple. I would have to think Warren Buffett could possibly be down on the entire trade right now. It's very possible. I don't know what his price average is, but it's in here somewhere because the stock has been
above. I got to step in here and say,
yeah,
it's a 50% probability he's down, if not more. But whatever remains of that is he's flat because he lifted Goldman on puts before the news came out. You know what I mean? Like either he's.
I don't know if he's.
I don't. He bought puts.
Nah, he's not buying puts. He's not buying puts. I don't think he's buying puts. I mean, he's actually a huge net seller of puts. That's how he makes so much money.
He is a net seller of options.
He loves to sell naked puts, but
right. Right. You're right. He's not a premium buyer. That's a good point.
Yeah.
So what would he do? He would have to sell
He's
the
not doing
stock.
anything. He doesn't care. First of all, the stock will rally again at some point, and hopefully he'll be alive to see it, and he'll say how you guys got to keep buying. But
We're just going back and forth here. But if what I'm about to say is a fact, and it's not, it's conjecture, but it's strong conjecture. The Swiss National Bank was a seller of Apple in October before the dump. How could the Swiss National Bank be sellers? And I know that Buffett's a fundamentalist, Graham Dodd, Security and Out, Benjamin. I've read those books, and I know that. But he's also a trader. I mean, Druckenmiller was a trader, right? I mean, so how could the Swiss National Bank be offloading, assuming what I'm saying is a fact, and Buffett, A, not know about it, and B, not do something about it? What would he do other than sell a stock if he's not a premium buyer? And I know he's, like you said, he's not a premium buyer.
I don't think it would shock me if he reduced his position. So if the stock goes to 140, I would say there's 100%, obviously 140 is a lot different than 160, but the stock moves pretty quickly, and the low of the year is in the low 150s. The bottom line is in the 150, 140, he's 100% down on the whole stake, his genius position. So the stock went from 90 where he bought it to 240. He didn't make a sale. He bought more. So, and that made the stock worth $1 billion, and he didn't make a sale. So he's not making one here. Needless to say, he's not taking heed. Although, what's interesting as well with him, I remember a couple of months ago, he took huge stakes in these banks. He's long bank. He bought so much Bank America at 28, 29, 30. Stock's 24. He bought JP. It's interesting. I got to think. And again, I'm not looking at his stock. I don't know if you want to pull up Berkshire Hathaway. I think it's B or whatever.
Pull it up.
It's got to be getting crushed. So I'd like to see it, but I don't want to harp on him and all of that.
No.
But
I think it's actually really important because is he not one of the most important investors, if not the most important in the stock market? To pay attention to what he's doing or not doing. Like the stock market's selling off. It could be him selling.
I'm just shocked at here's what I'm really shocked at. And someone ran this stat. I don't know if it's worked for the last week, but before that, if you bought the close every night and sold the opening, you would be up. I don't even know. It was like some huge number, like 20%. So like what they're saying is every morning from the night before we're up big. We end down, but we're up big. And that trade has worked. When this move is going to be particularly over is the day that we open down 30. When we open down 20, 30, 40, whatever that number is, that's the day where you can buy. But these openings down 50 cents after being down $27 it's nothing. It's
not
ridiculous.
Necessarily a buy. Right.
No,
right.
it's a sale. I mean, we're going to go back down probably and test somewhere at least yesterday's low after we broke last night through yesterday's low. So that being said, to me, the opening is a short. Nothing really going on today. Apple's down. This Facebook is a humongous issue. It's down another 2% pre-open, and they haven't even gotten the margin calls yet. And I'm just looking at stocks. Could you put up an NVIDIA chart, Mike? I mean, NVIDIA is probably one of the most amazing moves I've ever seen. I mean, this move literally is insane. The stock went from 294 to 135. It's down more than 50%. It's taken out. We're back to where we were in basically almost 17 when it crossed 100. And it's taken out like 2 years. And the thing is, it doesn't sound so bad if you bought it 2 years ago. You kind of just gave up a lot of money and you're even. But no one does that, Vince. Everybody's buying the whole way up. And everybody's broker in Apple called them at 190, 200, whatever the number is. Like, listen, Apple's down like $35. You know, it's a layup. Well, now it's down Now it's down $75 and it's heading lower. So, so what are they telling them now? Go here, hit up Goldman Sachs. Look at a charting. You can't. Listen, there's 6 days trading days or 7 trading days left in the year. Look at that chart.
Well, the Goldman one's interesting for a different reason. The NVIDIA one, it's been running up for a few years. This Goldman one, like we have detailed, this chart now, you can take a look. We're back to 2014 levels. Goldman has not done anything really since 2000. This is 2009.
It really hasn't done anything since 2000 when they bought Spear and the stock was $140 a share. It's never split. That's 18 years ago. So, you're up like $30.
We're back to 2006 levels in Goldman, basically.
Yeah. I mean, listen, Goldman's been lower, it's been higher, but overall, as an investment, and you know how many partners have come out of there with hundreds of millions, if not billions? Lloyd's a billionaire. I mean, a billionaire. The shareholders didn't make anything, but he's a billionaire. So at the end of the day, that's why active trading, in my mind, works really, really well. Now, obviously, in a straight up 9 or 8 year market, it becomes a lot more difficult. But the next 10 years here are going to be what I call our time. And our time is the time where you have to, pick your spots. We're going to be long, we're going to be short, we're going to be trading. And that will outperform, passive long only management. And I'm curious, what is the market down this month? 8.5, 9? I mean, it's down. I know they're trying to get it down 14 because then it'll be the world record since the Depression. They'll get it down another 4%. But we're down. We're down at least 8.
Russell is down 9.5. S&P. You know what? I'm actually looking at 1 month, so I'm not looking at month to date. I need to grab
so I think the S&P is down 8.5, something in there. The record they keep saying on CNBC is 1931, the Great Depression. In December, we went down like 12% or 13%. I don't think we'll get there, but they want it down a lot. I think you're going to see some crazy stuff, especially today and tomorrow into triple expiration.
Well, I was about to say, so what's the trade into triple witching? What would you typically do? What are you expecting? You had a great trade on the March-December one 3 months ago.
That was the dead high tech.
So what are your thoughts for this month?
I think there's a great possibility that we will trade a price that may not be seen on the cash out for Friday, but it depends on today's action. So if today gets very, very weak, tomorrow's opening might be really, really weak, and that'll be the low of this move for now. Now, I don't know how low we go today. That's the question, but we could hit Tracy's numbers if, in fact, it's for sale. So I would say the best way to play this is to be short December futures and long March futures. That spread is down to about $1.25. It was like $4. So that spread has been coming in, but I would be a buyer of that spread. It's trading at $1.25.
Do you think they're going to try to mark December lower and then bid
potentially?
It up?
I'm going to have a better handle
into the close, something like that.
I'm going to have a better handle on that later today, which I will, give out in the chat or back on audio, video. Right now, I'm not sure. It depends on today's action. What I would like to see and what I think is good for people is to see. One of these times, we've got to see it down open. Every time we do this show, the S&P is up. It's turned negative now, but it's always up. So the market's gone down now 14 or 15 from the highs, and every day we're up. So I'm expecting to have a big whitewash, on the opening potentially tomorrow, and that may be the end of this move. That being said, into next year, I'm not bullish, but there's got to be people that need to maneuver. Let me ask you a question. You're long Apple. You're outsized long. The stock is down 20% for the quarter, maybe more. It might be down 23% for the quarter. You're not making a sale. You're just sitting on it. How could you sit on it? Didn't you there?
Yeah, I'm here.
How could you sit on a 23% loss for a quarter?
Because my broker tells me I'm an investor in for the long term after it goes down. And when it goes up, it's a trade to sell. I'm unduly influenced by my broker. That's why.
Apple's down 27% for the quarter.
Right.
Okay, you can't sit in it. How is anybody going to sit in it? You're going to just say, okay. I'm not talking. Listen, a long-term investor, someone at a regional firm, yeah, they could sit in it.
Well,
but a hedge fund can't sit in
with
it.
that, I'm actually looking at a Twitter feed of a friend of mine's who's a investment advisor, long term, does a lot of tax and long term sort of stuff. He says, during market volatility, stay calm.
Right,
and don't sell. That's what he says on Twitter. That's what they told their clients 3 weeks ago. It's stay calm.
Right. Well, listen.
Because for the past 50 years, that's fine. Just buy and sell.
No, you blew yourself out. Nobody held in 08. Okay, nobody. I had a country. I had a country club with.
666.
Listen, I live in a country club. I'm not going to disclose the location, so no one can come visit me. But there's 1,400 homes in the club. More than 800 were bankrupt, meaning bankrupt to the club. They couldn't pay the club dues.
So you mean talking about in 07, 08, right?
Yep. Talking about 08, 09.
That was happening around here.
Well, I'm saying 08, 09, the thing was bankrupt. People, like, if you didn't pay your club dues right now, they'd kick you out within 30 days. You'd be like on suspension. Back then, they were like, okay, you can't pay, just keep eating food so we could support the club. I mean, so I agree. Don't be calm until you blow up, and then you're going to have big issues. And this is the first year this is how I see the cycle, and maybe I'm wrong. I'd like some input. So I ran a hedge fund to the outside world in 08. We had investors. Our investors literally begged us not to make a trade. Sit in cash, don't do anything, please. Okay. That went on in 08, 09, 10, and 11. By 2012, people sort of came out of the coma, and then they went long. So really, the longs have only been long since 12, 13. They've missed a lot of this move. Now, they've caught a lot of this move, but they've missed a lot of this move. Listen, if we get back down to the election night lows, which is like the low 2000s or middle 2000s, people are basically decimated. So I think potentially in this move, we'll definitely see 2450. But we could see like 2,200 at some point. We may not bounce out of here. And my thought is it could really get ugly here. And really technology, and maybe I'm wrong on this, technology probably doesn't have the earnings to back up. Like, people are buying Amazon. Like, I was talking to a guy, he bought a bunch of options in Amazon. He was up millions on these options. He's now down money. And he's like, don't worry, it's going to come back. I'm like, do you really believe this thing is going to 2,000? And he's like, yeah. I'm like, why? He's like, because it has to go up. It's like what your guy said, Mike. Just stay calm and never sell. Why never sell? Maybe you can sell and get a better price, lower. No? It's
not their model.
Well, even if they're not active traders, even if they're not playing that, or market timing, even if they're not doing that, which is what you're saying. Like, for example, buy and hold isn't as good as going to cash at certain times to preserve, even if you're only a long player. But to their point, which is their problem that they're running into now, you can say you have been able to say for the last, like you said, 50 years, it's just volatility. Don't worry. And when you say that to a 40-year-old, that's okay. But when you're talking to a 60-year-old and you say it's just volatility, don't sell, that's a problem, because they're going to start needing income and they're going to start liquidating 401ks to live off of. So you can no longer ignore short-term volatility when you are going to start taking withdrawals on retirement funds, which is why people that are, the boomer generation, as they get older, they're going to be selling stocks and putting it into something that's going to be less volatile. And the mantra, to use your word, of don't sell, remain calm, it's worked for the past 50 years, is going to be fought back with, dude, I'm 70. I've got 10 years left to live. How many years do I have to wait for this to go back up? I don't have the time. Put me in CDs, and which creates a whole other problem. But that's the point. We're running into that defense or coping mechanism by brokers of saying, ignore the volatility, remain calm, is running into, dude, I'm going to be dead in 10 years. It's time for me. It's time for me to get out of the volatility of day to day and start to be able to live. And that's it. Too much of people's wealth is tied up in stocks.
I think it goes even deeper than that. How about this? How about, I know offhand through my family, many people are retired with 500 grand, 400 grand, 800 grand, whatever the numbers are, and they've been long equities 100% and leveraged, okay? And they're able to live their life over the last bunch of years, because if that 800 grand made 10, 12, 15, they're making six figures plus they're leveraged, that pays their lifestyle. This is the first year where not only is it not paying their lifestyle, they're actually down money, and now their 800 grand is 760 grand, and they had to live. So they had to live for 50. They're now down to 700. And now they're freaking out because they can't make the return, and the money has dissipated, and now the return is only on 700 or whatever the numbers are. And that, I'm not worried about, like, I'm always worried about my kids, but I'm not really worried about my kids and their investments, because it's irrelevant today what they're doing. They're making a small income to cover whatever losses they have. They don't have, a family. They're not. I'm more worried about the people like ourselves that are in our, I don't want to disclose our age, but we're in our 50s, and what's going to happen if in the next 10 years our portfolios are flat to negative or negative a lot in 10 years? Right. Now all of a sudden you're 65 or whatever your number is, and you're down money. We've never seen that.
Environment. I mean, this is the anti-Goldilocks environment. The baby boomer generation, whatever age they are, they're like a pig in a python. Wherever they are on the timeline, they distort things, So it was houses after World War II. It was gyms in the 80s and 401ks, and now stocks. And now it's going to be, hospice care, because, and those are the stocks you're going to have to buy. In the meantime, these people, this generation, born before 1964, they need to live. And if they're not independently wealthy, even if they are, as you described, someone who could be well off, but is levered to the market and dependent on the market so much, that's going to be a problem, because it ends up looking like a Ponzi scheme. When you have 10 million people sell stocks so they can buy a loaf of bread, to exaggerate a concept, who's going to pick up the slack to keep the stocks sideways? And even if the stocks do go sideways, to your point, even if the stocks were stabilized sideways, you're going to have inflation. And you're going to have the bad kind of inflation. And so anybody who's putting their money in that 2 or 3% CD 5 years down the road for stability is still going to be chasing, in my opinion, higher inflation, which has to be ultimately a result of monetizing the debt the way we're going to down the road. So it's anti-Goldilocks time, and the question is, how will the standard of living change for people in America? The next generation is going to carry it on their back.
Yeah, I think you're right. It's just, I'm waiting on a trading basis to see some kind of panic, some kind of something that gives me the validity to think, hey, this is the bottom. And it may, listen, it may be
yesterday's 100-point range. We traded 100 points yesterday in the S&P.
Yeah, but there's no panic. We were up 40. Anyone that came in long made a shit ton of money unless they held on for 80 handles. You could have took them long into the Fed and made over 40 points. When has that ever happened? Go back on your little charting and see the last time going into the Fed that we were up 40
Well, it
handles.
depends who you're talking about. A short-term trader, yes, but most people aren't trading.
Right, but
in
if
and
you're
out.
not
minute
trading
by
like
minute.
that, it's
agree with
irrelevant.
capitulation.
It
Regardless
doesn't
of
matter. If we go
capitulation.
down 70 handles today, they're not selling. So it's
We
irrelevant.
are looking for capitulation. We can agree
Right.
on that.
That's
And
all
one
I'm
of the
looking
signs of
for. I'm not,
capitulation-
I mean, yesterday, being up 40 handles gives anybody who's long.
Here's the next argument, by the way. So supposedly the equity markets are agitated yesterday because Powell's talking about 2 hikes. You might argue if we actually get those 2 hikes, that would be the best thing for the market, because that actually means that we are continuing strong. And right now, the people that are really selling the market are basically the ones saying that we don't buy how strong the growth is going to continue for next year. We think that China, US is going to have negative implications on trade. If we actually get 2 hikes, it's because things are not nearly as bad as people are fearing at this moment. But the other side of that is the next positive that maybe the market is hoping for is eventually Powell coming out with a statement in a month from now saying, you know what, I was wrong, we're expecting 1 hike. That's the other way of looking at it. Okay, now he's more dovish, but at the same time, he's acknowledging, wow, things really aren't turning, things are worse than we're expecting. So it's a bit of a different dynamic than what we've seen in the past, where either we're going to get positive news and they're going to further hike, or we're going to get negative news and they're going to become more dovish because they're forced to.
Right. That's true. And there are a lot of they're having press conferences after every meeting now, and that in and of itself shows more flexibility. The question is, would they exercise that flexibility? And I think you just painted a nice picture of the circumstances that would enable them to use that flexibility.
It's funny, going back to the quarterbacking of yesterday's press conference. Powell's a new guy in the chair, and typically within 12 months of any new Fed chair coming in, there's a market correction. And with them coming out with more transparency, the negative impact of the more transparency is, supposedly the markets are selling off on 2 or 3 comments that he made specifically. And one of them was, no, we're not going to hike 3 times next year, we're going to hike 2 times. The added transparency sometimes, especially in the algo world, the headline-driven world, it's creating more volatility in itself.
But my question is, why do they want to be so transparent when it really is irrelevant? They're not raising 3 times next year. There's not a chance. There's not a chance of that. There's just not. The growth is much slower. There's not a chance of that. So why even say anything? Why don't they just come out and just say we're data dependent, which is what they should be? Why do they have to determine what's going to be 1 year from today? Nobody can do. You couldn't tell me where the stock market's going to be 1 year from today. So how can they tell you what they're going to do a year from today? A year is a long time. So why put it out there? Like Apple stopped giving guidance because it's actually ridiculous. I mean, they couldn't do it.
So I want to bring it. If I don't mind, I want to bring it back to the capitulation thing. Let's talk like active trading. If yesterday wasn't a capitulation, I'm thinking about what would be a capitulation. Maybe a new low with volatility actually spiking for a change. Maybe that will be something an active trader would be looking at as a sign to possibly start to look to get long for a day trade. I'm throwing that at you, Larry. Because
I think the capitulation to me would be a down 30 to 50 opening.
Oh,
heavy volume.
The reversal of that concept you were talking about. Right.
Well, yes, because at least then the market would show that what it's made of. Like right now, today, the market's flat on the day. What are they telling you? Nothing. I mean, there's got to be selling at some level, either today or tomorrow. I mean, if we hang down here now, if we rally out of here, that's something different. But Apple is trading at 160. It was just 159 and change. When is anybody going to sell that? Never. I mean, we've discussed it that the long term, like Mike's friend, the RIA, they're telling their clients to buy. They've been telling their clients to buy the whole time, and now they're telling their clients to hold on. So it's like a roller coaster. It's like, get on the ride. You don't have to hold on. Take your seatbelt off. Now all of a sudden they're like, strap in. Don't sell. So really that's a different trade than what I'm thinking. I'm looking at hedge funds. I'm looking at people out there that have, gotten hit to make a move, and I haven't seen it. I haven't seen a lot of selling. Obviously there's selling every day, but I haven't seen a lot of, like, I haven't sat at my desk and said, "Holy cow," or another word. Yeah, it's just been bids at every tick. The market went down 100 yesterday, but it was up 50. So it went from up 50 to down 50. So it wasn't like, we were down at the most 2%. Is that really a smash? 2%? So I'm go if you think that, go step into crude. Crude is down 3% already today, and it's up 2% off the low. It was down 5% this morning. So that to me is something that I'd like to see to make a bottom in here. And I don't think that we're going to make a bottom until we see that.
Okay, that's exactly what I'm looking for. That type of insight.
I don't think we'll make a bottom until me and you get on the phone or in the chat and go, "Holy cow."
Right. So,
listen, and I've done it with my friends for years, and they've called me up, and I speak to the same guys every day for the last 20 years, and we're like, "This is the craziest thing I've ever seen." I want one of those. This is the craziest thing I've ever seen. This move is crazy. So I haven't seen that. Even yesterday, yeah, we went down, but the market ended down, I think, 30 something, and it was up 40 something, but we bounced. We had 25 handle reversals inside of that down, so there was a way out.
Right.
I want to
So
see
what
it
are your
with
thoughts
his-
for today? After a huge day range yesterday, we had about 100 point
I
trade
think
range.
that the market should make a bottom in here, but again, we got triple expiration tomorrow. I do think there's going to be selling. I do think the low is going to be made in here today or tomorrow on the market for the rest of the year. Whatever level that is, that could be 50 points from here. But overall, the market's in very bad shape for next year, and there's a lot of pain out there. But I'd like to see a capitulation sell-off. But for today, market will, trade around. I think it's just a trade around market. But the thing that scares me, I'm looking at my DAX. It's down 180 points on the year low. It made a new year low today, and it's down 18% for the year. That scares me. that these foreign markets, and you talk about the RIA guys, your guys that are saying don't sell. Those guys, and we know these guys on our floor who manage money, and they're very, very good. Their portfolios, I spoke to them before this whole down move. They were down 5 to 7. They've got to be down 14 right now because they have international exposure. They have exposure, they're overweighted in financials, and they're overweighted in technology. So it wouldn't shock me to see it down 15. So I think portfolios across the board, especially in the RIA space, are down big. And I think all these guys put their clients in because this is the first dip that we've had in a long time, and they've been waiting to buy the dip. So I think if they don't rally them in the next 5 days, which I'm hoping that we don't go too far from here, people are going to have to put the report card out. And that report card is not good for clients, and they're not used to it. So, on a longer term, I'd like to see the capitulation. Haven't seen it yet. I mean, have you seen it? Has anyone seen it?
For me, capitulation. I mean, I'm an options-based person. I usually would, if I was making markets, I would see it, in a really hard swing and skew, where back spreads just look ridiculous, and when I'm making markets and no one will hit my bid, bidding through my offer, those type of things would be signs of capitulation for me. So, but as a technician I think would typically look for a lower low, whatever time frame he looks at, whether it be daily or hourly or weekly. Look for a lower low with a non-confirmation on stochastics or RSI, not making a lower low. But as an active trader, you've got to look for things like you do. We're making lower lows, but the Nasdaq isn't making lower lows. Volatility is spiking. That could be capitulation. But no, I think capitulation comes when uh, we have sideways movement, a drop, and then sideways movement again. And I say that because there are shorts out there like Gunlock, like Dalio, that are buying from these people selling. And I think that there's going to be a brick under the market that's them buying, and they're buying now too. I think, and I think the market will come to them. And then
I
they
don't know if Dalio's short. I mean, he's running just such a big book that how could he even be
Yeah,
that
he could be
short?
defensive. He's not short.
He's not
There's a
short.
headline that just came out. I just posted. It says, reportedly, U.S. and over a dozen allies plan to openly accuse China about its economic espionage activities. I think you're talking about capitulation. I don't think there can be capitulation until global trade is in a more settled place. Right now, there's just way too much uncertainty with major trading players. We've been exporting globally. Every country is so reliant now on China, on the U.S., with what they manufacture, what they agriculture, everything, that there's too much up in the air right now. Companies don't know how to plan for the future right now because they just don't know what the game plan is, and they don't know who's going to be buying what products at what tariff level. So there's just tons of uncertainty. I think that's part of what we're seeing.
I just see these foreign markets like the DAX now. The DAX was down here early last night when the SPU was $20 lower than this. It's back down below 10,600, and it's right there now. It just bounced a little bit, but that to me is the scarier part. It's the DAX is down 18% for the year. That's in a bear market off the year. They're calling us almost in a bear market from the high, and we're barely down. That market is 25 to 30% off the high of the year, and it's down. It's down 18%, and it's bidless. I'm watching it. It came in lower. It bounced. It's 30 points off the low of the day, and hundreds of points off the high of the day. So you got to keep an eye on foreign markets. I think the market's going to get hit again. I just don't know what level to, and then potentially tomorrow's opening, if it's a big down opening, would be a buy. But until I see something big on the downside, on the opening, I don't think the market's a buy. But that's just my thought. And we've gone a long time. We're only 10 minutes before the opening, so I want to get ready. Mike, you want to go over the schedule today?
Schedule for the day is a touch of volatility. We're going to have Phil Flynn coming up at 10 o'clock, Price Futures Group, Fox Business contributor, talking energy, talking equities, talking macro, his thoughts, talking to other traders. So we'll be speaking with Phil at 10. He's always got a lot of great info. And then 11 o'clock, all things energy talk. Bryn Kelly, Mike Korn, between the volatility with crude oil, natural gas, Bryn, actually, it's funny, she said to me, how much time do I have? Because I've got so much to talk about. So she'll be going on, it'll be probably just under an hour or so, but she's got tons of great information as always. She has a lot to talk about, discuss, so that's a great segment. That's 11 o'clock. And then we'll be back on in the afternoon especially talking about the triple witching coming up tomorrow, different strategies for that. That'll be in the afternoon. That's the plan.
Before we walk off, there's a question. I just want to comment, gold is now above 1262. And if it settles above that, you could have more momentum buyers come in and take it higher, and the dollar's going nowhere. But before I give it back to Larry, Bob Brew is asking, at what point do you think most folks, and I think, meaning common middle class, normal human beings, would actually say, get me out? And I think that's a very broad question, and it's tough to answer without being narrow, Bob. But by most folks, let's say people between 50 and 70,
Never.
that have 80% of their net worth in the stock market. I don't know, Larry. What do you think? At what point do most?
I don't think anybody has 80% in, unless they're much older looking for return. But I don't know what that number is. We could talk to Mike's RIA guy to see what the asset mix is. But overall, the answer to that question, honestly, is pretty much never. until they're being tapped on the shoulder?
Well, everybody, it depends on, it's a much deeper question because it depends on who the person is, when they actually even got involved in the market,
Right.
you know, who they are, what their net worth is. A lot of different factors go into it. You know,
Wait.
traders, investors.
I'm calling a timeout, okay? Because I've
Right,
run
it's a-
money.
it's-
I'm calling a
it's a broad
timeout.
question.
I've run
It's a very
money,
broad question.
okay? And nobody is looking at it like that, Mike. They're looking at their net worth every month or every year. It doesn't matter that last year they were worth $1 million and now they have $1.2 million. They're looking at it
I'm
every
only
year.
saying as well, the broad term is I actually think not many people have gotten back in this market, period. I think that stock ownership has really gone toward the, 1%, and, then it gets more involved with like, how are they actually, it's a much different world out there.
I just think they're never selling.
But either way, we're traders. So it's not even like this is kind of actually out of our kind of repertoire. We're looking at the market on a 1 week basis, week in, week out, looking for opportunities.
Right, but it was a question for a subscriber. I wanted to
No, and I appreciate it. And the truth is, I don't think they're even thinking about selling. Honestly, why would they sell? They want to buy more.
To be honest, that's what Larry's saying is actually the sense from. I speak to a few different investment advisors, and that's the correct. Well, that is what they're saying. They're actually saying, I was just at lunch with a guy. He said, I'm buying more Apple here.
Right, but I've
they're
seen
giving
this,
a dividend. They're doing this.
I've seen this movie before, and this movie doesn't end well. They're buying Apple at 160. Now they're going to triple their position or double their position, and if it goes to 140, they're freaking out and looking to get out. We've seen it. Why do you think Apple traded down to $70 back before Buffett took the stake and it wouldn't rally for a year and a half? Is because they recycled everybody out of the positions. So again, markets are holding up rather well relative to external factors here. So we'll see what they want to do today. Looks like they want to try to rally them at some point, but we'll see if we can hold the lows.
All right, let's end it on that.